Money. Money.
I wanted to talk about the single close program, which is a permanent loan consisting of construction and permanent financing. Financing is available for ground up construction, major remodel projects, and teardowns. This is really a great opportunity with the challenge that we're having in the market right now. If you've got an opportunity to build your own home using a single close construction loan, or also rehab. So it's a really great opportunity if you own a home right now and there's just nothing available on the market for you, to be able to rehab and make your home new and make it your dream home. This is a great product to be able to do that. So it is for primary residents only, not for investors. 90% maximum loan to value. Again, it can be used for purchase, new construction, purchasing land and building your own home, rehab. It's for one unit properties. The construction term is for 12 months. It's interest only during the construction loan period, and then it'll turn into an actual full principal and interest mortgage. The maximum loan amount is conforming high balance. So in our area here, that would be $592,250 with minimum credit score of 680. Now, eligible property is, again, single family home. So ineligible is non-occupied properties. Cash outs not available for cash out, or owner builder specs are not available, or condos. So the loan to value calculation, so again, it goes up to 90%. It's the lesser of the acquisition cost or appraised value. And if the borrower is on the title of the lot, structure, and refinance, and the LTV is based on the site value from the appraisal, and the cost of the construction or appraised value, whichever is less. So if the borrower purchases a lot, the structure as purchased and the LTV based is on the lot price and the cost of contract or the appraised value, whichever is less. Now, the steps for the construction loan, first is the credit application process. So this is going to be for the borrower on the loan. So they're going to go through that process, and you can actually do at the same time the builder acceptance as well. So they're going to go through an approval process, paper documents that they're going to have to complete and provide for the lender. So you can kind of go through that process at the same time. And you're going through credit approval, just like you would for a standard process. You're going through credit approval for you as the borrower, as well as the approval again for the builder. Now, step 4 is going to be the collateral approval. So collateral on the property, underwriting for the construction loan goes through the construction lending process. Step 5 is your prior to closing. So conference calls occur between the construction department and the builder, as well as the buyer or the borrower on the loan, are all involved in those conference calls. The next step is the loan closing. So the loans close prior to the construction. And step 7 is the construction phase. So once the loan is funded, as the house is getting built through, the construction draws are made to the builder. Interest-only payments are made by the borrower during that time. And then the last is your permanent phase. So the permanent phase is once the loan, it's going to reclose to a fully amortized first mortgage. Permanent housing payment begins. So those are the steps through the process. Now, the loan cannot be increased after closing because the loan is closed and is a final amount. So the borrower must pay for any of the change orders. This can be done, but the lender must be notified of any of those change orders in excess of 5% of the loan amount. Contingency reserve may be established to cover costs such as this, because a lot of times you can see that happen. Now, the inspections are performed by third-party approved inspectors with the mortgage lender. The original appraisal is always requested to perform the final inspection once the home is completed. The borrower cannot act as his own contractor. Majority of the time, they're going to want to have an actual builder, and again, going through that process. You're going to collect, typically there's 7 draws for the inspection, so you can take as many or as few as you want on these. If you take more than 7, then there's charges for the additional inspections when the construction is completed. And if you take less, the inspection fees that were collected are credited back to you. The builder decides on the phases for the draw, so dedicated to the disbursement scheduled for the builder has to follow as long as it is reasonable. And if the builder cannot complete the project in 12 months, because again, the construction period is for a 12-month period, you have the ability to extend the loan to allow for more time, but the fee is going to be assessed at that time, so it can get a little spendy if you go past that. So you want to make sure that things are staying online and on time for those construction processes. So just a little bit about a construction loan. There's a lot that goes into it, but it really is a great opportunity. And I really wanted to talk to people that are currently own homes right now and are having challenges finding the home that they want. They're concerned about selling and being able to find another home, that there is an alternative in using a construction loan outside of your standard refinance or the standard rehab loan. This is just a little bit different than that. So any more information, please feel free to call the show at 1-855-400-1150. Again, that's 1-855-400-1150. And coming up next on the Money Hour, attainable housing, the demand of housing for significantly outpaced residential housing supply. Shannon Affolter with Master Builder Association right here in 1150 AM KKNW after the short break.